The Rich Dad Poor Dad author has been warning about stocks and growth for more than 2 years. The stock market crash will be the biggest in history. In a recent tweet, Robert Kiyosaki, the renowned author of the best-selling book Rich Dad Poor Dad, has issued a stark warning to investors about a potential looming crisis. He has expressed concern about a significant market crash and even the possibility of a depression. Kiyosaki attributes this potential crisis to the actions of the Federal Reserve, suggesting that they might inject billions of dollars into the economy, which he refers to as fake money. No doubt, Robert Kiyosaki has the ability to anticipate market trends, and his recent prediction has stirred both excitement and skepticism among crypto enthusiasts. One of the main predictions revolves around the Federal Reserve and its role as either a savior or a potential source of destruction. The Federal Reserve is currently facing a complex dilemma. With an impending major economic downturn on the horizon, they have taken a controversial course of action to avert a financial disaster. Their chosen strategy involves printing an extensive amount of new currency, raising concerns about the implications of flooding the economy with what some consider to be essentially counterfeit money. This decision by the Federal Reserve has ignited debates and uncertainties about its long-term impact. You might be wondering, how does this connect to Bitcoin? Well, according to Kiyosaki, the excessive printing of money by the Federal Reserve will gradually erode people's trust in the US dollar. When times are uncertain, individuals often turn to safe haven assets for security. This is where assets like gold, silver, and Bitcoin come into the picture. Kiyosaki confidently predicts that by the year 2025, the value of Bitcoin will skyrocket to an astonishing $500,000 per Bitcoin. Yes, you read that right. $500,000 for one Bitcoin. He also foresees gold reaching a value of $5,000 and silver reaching $500. It seems like he's suggesting that if we want to protect our financial future, he's advising us to hold onto these valuable metals and digital currencies tightly. Before we brush aside these predictions as mere imagination, it's important to know that Kiyosaki has a track record of unsettlingly accurate forecasts. His past predictions have left people amazed and puzzled. Take May 2022, for instance, when Bitcoin was hovering around $29,000. Kiyosaki cautioned about an impending decline. True enough, his prediction came true as Bitcoin's value plummeted to around $15,000 in November, shortly after the FTX crypto exchange faced troubles. While not hitting the exact figures of $11,000 or $9,000 he mentioned, the drop was certainly significant. There's an uncanny knack this man seems to possess, enabling him to peer through the market's veil of unpredictability. Now let's shift our attention to another recent forecast. The recent failures of Silicon Valley Bank and Signature Bank in the US have reverberated across global stock markets. It's akin to a financial domino game where banks are apprehensive about a chain reaction. Who steps in to raise the alarm once more? None other than the esteemed Robert Kiyosaki. This time, his focus is on Credit Suisse, a major European investment bank. As per his predictive insights, Credit Suisse stands as the next vulnerable institution on the brink of collapse. However, why is Kiyosaki expressing such concern? His worry stems from his belief that the US dollar is on the brink of significant trouble, weakening the country's overall stability. He points to the bond market as the core issue, cautioning that the dollar's global dominance is diminishing. To counter this slide, he predicts that the Federal Reserve will continue printing money, a situation that's becoming increasingly inflated. During a recent appearance on Fox News, Kiyosaki likened the bond market to a towering entity overshadowing even the stock market. He drew a striking analogy, comparing the Federal Reserve to both firefighters and the ones who ignited the flames, referring to their attempts to address problems they themselves created. This worrisome outlook becomes especially pertinent with the impending retirement of his generation, which he dubs a brewing perfect storm on the horizon. If his predictions materialize, the burden of the aftermath might rest on American taxpayers, as they could be responsible for bank bailouts in the event of a financial crisis. Now let's focus on Credit Suisse, the primary target of his concerns. Just before the Swiss bank revealed weaknesses in its reporting procedures, Kiyosaki singled them out as the next potential victim of financial turbulence. It appears that his predictions are gaining attention in these uncertain times. He suggests thinking about silver and gold as safe choices to protect yourself from economic uncertainties. And what's his third recent revelation that's poised to make waves globally? He took to Twitter to express his thoughts, and he's not holding anything back. He predicts that in 2023, silver might jump to an impressive $75, while gold could flaunt an astonishing value of $3,800. That's a significant increase in value for your investment portfolio. But let's backtrack a bit. How did Kiyosaki develop such an affinity for precious metals? Going way back to 1972, when he was a courageous Marine pilot operating behind enemy lines in Vietnam, he adopted a fondness for gold. He planned to buy gold at a discount due to its source being an adversary's mine. A shrewd move indeed. Not only that, he developed a fascination for silver in 1964 when he noticed the copper edge on a 10-cent coin. This was his realization that we were being missiled by our currency. Apparently, the US government went against Gresham's law, which suggests that inferior money drives out gold and silver. Fast forward to the present day and the core of his concerns. He contends that the stock market is hurtling toward a crash, and this spells opportunity for the valuable assets, gold and silver. He advises investors that this might be their final chance to secure these precious metals at lower prices before they surge. And let's be clear, Kiyosaki doesn't mince words. He harbors distrust for the Biden administration, the Federal Reserve, the Treasury, and even Wall Street. He firmly believes that the Federal Reserve's approach of raising interest rates to combat inflation will lead to the downfall of stocks, bonds, real estate, and even the US dollar itself. Adding to this, he boldly asserts that the US dollar is perilously close to losing its value entirely. But there's no need to panic. He offers wise advice for these uncertain times. In addition to gold and silver, he's also a strong supporter of Bitcoin. He predicts that as the Federal Reserve chooses to print trillions in fake dollars, Bitcoin investors will be celebrating. Well, he's not just a promoter, but a Bitcoin investor himself. So it's fair to say that his predictions hold personal significance. Without delaying further, let's look into the next forecast. In an emphatic tweet on 24th March 2023, he once again criticized the Federal Reserve, predicting that their policy of raising interest rates would result in a severe crash. Prepare yourself as he envisions stocks, bonds, real estate, and even the US dollar falling steeply into a downward spiral. But that's not the end of it. There's another facet to this grim perspective. He continues by forecasting that this crash might set off an immense collapse of $1 quadrillion in the derivatives market. Just to make it clear, a quadrillion equals an astonishing 1,000 trillion. It's quite an overwhelming prospect. His worries stretch to the global arena as he presents a bold statement that's bound to speculate discussions. The markets are in turmoil. Everything is shifting. And if you're not paying attention, you're going to get wiped out. This is about the greatest bubble, and for those of you with a 401,000 hoping for retirement or playing golf for the rest of your life, you better pay attention. Because I think a lot of other people think the biggest stock market crash is upon us. The current state of the markets is indeed marked by significant turbulence and uncertainty. Sudden and swift changes in the market, coupled with fluctuations in prices, can create unease among investors, particularly when discussions arise about speculative bubbles and the looming possibility of market downturns. The truth is, market turbulence can make anyone nervous. Here's what investors should know about dealing with it. During times of market volatility, resist the impulse to sell solely based on recent market movements. Selling stocks when the markets are down can turn temporary losses into permanent ones. It might be tough emotionally, but sticking to your plan could be more beneficial for your portfolio. This doesn't mean you should hold on without consideration, but we recommend evaluating an investment's future prospects and its role in your portfolio, rather than being influenced by noise and fear. Adopt a long-term perspective. Market trends usually involve both rises and falls, and it's probable that you'll encounter multiple noteworthy declines throughout an extended investment journey. Even bear markets, defined as periods when the market dropped over 20%, have historically been relatively brief when contrasted with bull markets. Since accurately predicting market fluctuations is nearly unfeasible, all investors would benefit from disregarding distractions and maintaining their concentration on their strategies. Evaluate your comfort with risk and your capacity for it. Risk tolerance refers to your emotional capacity to handle significant price fluctuations, while risk capacity pertains to your financial capability to endure losses. Market declines can serve as a reminder to reassess your risk tolerance, although it's advisable to wait until you're composed. On the other hand, risk capacity can and should be examined at any point. Do you possess sufficient funds to manage short-term objectives? Money earmarked for upcoming needs or that you can't afford to lose shouldn't be invested in stocks. It's more prudent to allocate it in relatively stable assets like money market funds, certificates of deposit, or treasury bills. For retirees, maintaining the equivalent of the next year's living expenses in a bank account or money market fund. coupled with several additional years' worth in bonds maturing as needed, can provide a sense of security during turbulent stock market periods. Ensure your portfolio is diversified. Market volatility can uncover instances where portfolios believed to be well diversified actually aren't. If you haven't reviewed your portfolio lately to comprehend the performance of each asset class and ensure it aligns with your intended asset allocation, now presents an opportune moment to re-examine it. Think about adding defensive assets for increased stability. Defensive assets like cash equivalents, U.S. government bonds, and Treasury securities can provide steadiness to a portfolio during stock market declines. Additionally, if you anticipate using funds from your portfolio in the upcoming years, it's wise to place that money in assets that have historically shown higher liquidity and lower volatility than stocks, such as short-term bonds and cash. This approach can help you sidestep the need to sell during a market downturn. Adjust your portfolio's balance as necessary. Market shifts can really distort your allocation from its initial goal. As time passes, assets that have appreciated will constitute a larger portion of your portfolio, while those that have decreased will represent a smaller share. Rebalancing involves selling positions that have become overweight in comparison to the rest of your portfolio and redirecting the proceeds to positions that have become underweight. Implementing this practice at regular intervals is advisable. Conclusion: Kiyosaki is advising people to get out of the stock market and invest in assets that will hold their value, such as gold, silver, and Bitcoin. He says that these assets will protect people from the crash and help them to build wealth in the future. Kiyosaki's advice is based on his belief that the stock market is a bubble that is about to burst. But the dangers are present. Placing money in items like gold, silver, and Bitcoin carries risks. These items can be unpredictable, causing their prices to fluctuate. So don't put all your eggs in one basket. Develop a diversified investment portfolio. A diversified investment portfolio includes a variety of assets, such as stocks, bonds, and real estate. This helps to reduce risk and maximize returns. If you found this video helpful, don't forget to subscribe to my channel and share your thoughts on Robert's predictions. Thank you.